I think negotiations are all about leverage, right? And so if they've got a number of parties on their side of the table where they can acquire, any number of firms and be happy with the end result, putting yourself in a similar situation, tends to increase the amount of demand, therefore increase the price and your ability to leverage terms. I think we talk a lot about price and value are not necessarily the only factors. If you leave 50 or 100,000 on the table at sale, but you really have a good relationship with the acquirer, and particularly if it's private equity where you might be staying on a little bit longer, that's going to that relationship and the fit between their philosophy and yours is going to matter a lot more than squeezing out that extra little bit on the sale price.
I'm Brandon Poe, and this is the Accountant's Flight Plan podcast, where you can enjoy engaging conversations about mergers and acquisitions and accounting practice management. Listen in on strategies to build a more fun and valuable accounting firm. Welcome to Accountant's Flight Plan. I've got a team member on as a guest. I think this is your second or third appearance, Morry. I can't remember.
Second or third one, yeah.
So Morry Brown is our market leader in California. And he and I spent some time last week at AICPA Engage in Las Vegas. And we talked about private equity, which is kind of a big thing in our industry. And so we've got some interesting conversations around that today. And I'd like to kick off by just getting Morry to share his story about how he came to PGA and how you got started.
Yeah, I did not come up the CPA side. I came up more the capital market side. So spent some time at Goldman Sachs and Citigroup, primarily focused on retail and consumer stocks at the time. I was in New York, so I moved out to LA back in 2014. Started working more in private capital markets. So worked with a few venture-backed companies, worked with a few private equity-backed companies, and then joined up here with Poe Group in 2021. Brandon and I are family friends, so it's great to kind of be in the mix here, and it's been an awesome experience getting the California market up and running the last 4 years.
Yeah, our family relationship's interesting. So my daughter, Bailey, is married to Reynolds, whose cousin is one of your best friends, right?
That's it. A circuitous relationship, yeah. But that's it, yeah.
Yeah, cool. Well, when you started with us in 2021, there was no private equity buyouts going on. These roll-ups weren't going on. And so it's interesting that your background is in the capital markets. So you've been around these roll-ups a bit. Were you surprised that PE came into the accounting industry?
I mean, I can't say that I was necessarily expecting it, but so from that standpoint, yes. But at the same time, if you look at the profile of the businesses, not surprised at all. A couple of the factors that I see there. One, you've got, dependable revenue sources. So much of the revenue is on contract basis, at least for the firms that the PE guys tend to be interested in. So they like the recurring revenue. The cash flow dynamics tend to be great. The marquee firms at a 40 or 50%, cash flow to owner margin. And then I think also, everyone knows it's difficult to find talent in the space these days. So there's a bit of a supply constraint there. All that is great for, rates and pricing longer term. So when you combine that with the fact that, up until 3 or 4 years ago, you could often buy these practices for, around 1 times revenue, which would generally be somewhere between 2 to 2.5 times cash flow. If you've got a pool of capital and that revenue is recurring, that's a very, very high ROI investment, right?
Yeah.
And since then, I think it's really only expanded because, the exit multiple opportunity now, as you put these firms together, there's really a bit of a distance here between, say, a 1 million revenue firm versus a 5 to 10 million revenue firm, and the exit valuations there. So I think that delta has opened up, and I think again it makes sense from their playbook to look at it that way.
Yeah. Yeah, it's I tell you, I've been surprised at the speed with which it has entered this market and accelerated in this market and how it has shifted. We've seen pricing models shift dramatically over the past 2, 3 years. I'd say 2 years. And most of these firms, like I'm assuming most firms that have any size to them are getting approached by PE right now in this market. Um, so yeah, it's an interesting time, and it will run its course. It will be a cycle. I've said that on numerous occasions. But I think there's a lot of consolidation that's going to happen. It's going to continue on for years. Um, but I think a lot of our clients, once they get involved with us and they see how we can bring buyers of all stripes to the table, it creates a completely different environment. So I'm going to just go ahead and warn everybody that this podcast is going to be a little bit, what is the term you said? Talk your own book. That's from your Goldman days. Can you explain that term real quick?
Yeah, basically talking your own interest, right? So, yeah, the phrase comes from if you have a portfolio of stocks and you're talking about one of them, you're probably going to talk positively about it if you own it, right? So, yeah, I think that can apply here too for us.
Yeah. So we're going to talk our own book. We're going to be open and transparent about that a little bit today. So, um, so if you're getting 2 or 3 offers, Morry, like if PE's reaching out to you and, hey, I've got 3 LOIs. I talked to a guy yesterday. He's like, I got 3 LOIs. Um, why should they use somebody like us? What is our value?
Yeah, I mean, I think I'll start there by thinking about it from the PE perspective. So, they're building a portfolio, right, and they're integrating that into a single company over time. Because they're thinking about it that way, right? If they've got a pool of capital that they need to deploy, let's say they need to acquire 10 firms this year, they're going to talk to, probably 100 firms, and then they'll make offers to, I don't know, 30, 40, 50 of the firms. And then you'll get down to the 10 that you actually move forward with. So if I'm a seller in this market, I always have to understand that that's what's on the other side of the table. And so that's how they operate. I think additionally, because of that, they are in the deal headspace 24/7. So they are, full-time negotiators of deal terms. And so if you're negotiating with them, one-on-one, or if you're negotiating, even if you have, a few offers, knowing that background, I think helps. What they tend to do is, put forth what I've called in the past kind of like NFL contract offers, where it's a large headline number, but there's of course a number of assumptions there underneath the hood.
So dig into that NFL offer, because when you first said that, I was like, what are you talking about? What is an NFL headline offer?
And what I'm meaning there is that often you'll see $100 million contract for 4 or 5 years for a player, and maybe 20 million of that is guaranteed. The rest is subject to either continued employment or bonuses and that sort of a thing. So it's not necessarily a cash number. That's often similar with PE. So they may offer you a $10 million deal. It may be 3 to 5 million cash at close. Then there would also be some sort of earnout component. There would be a salary package, compensation package, and then you might also get an equity piece in the larger firm. So there's a possibility for a second exit. The salary piece is generally fixed, so that one's kind of known, assuming you continue employment. But the earnout and the equity, are highly variable, right?
Yeah.
And they tend to present those offers, on positive terms for them, right, with an exit assumed at a high valuation and all of those things. So understanding, I think, the components of those offers, is very critical if you're looking to, be acquired by private equity, continue working with them.
Yeah. And I think, to kind of say what you're saying in a little bit different language, I feel like we create a market. And so if you can go and get 2 or 3 unsolicited offers when you're off market, like imagine what would happen if you were on market?
I think negotiations are all about leverage, right? And so if they've got a number of parties on their side of the table where they can acquire, any number of firms and be happy with the end result, putting yourself in a similar situation, tends to increase the amount of demand, therefore increase the price and your ability to leverage terms. I think we talk a lot about price and value are not necessarily the only factors. If you leave 50 or 100,000 on the table at sale, but you really have a good relationship with the acquirer, and particularly if it's private equity where you might be staying on a little bit longer, that's going to that relationship and the fit between their philosophy and yours is going to matter a lot more than squeezing out that extra little bit on the sale price. And I think that when you take the firm to market, you'll have a little bit better idea, and you'll be a little bit less likely to just purely follow the money, and you'll focus on that on that fit, which I think longer term is going to be more impactful to you as a seller.
Yeah, I think most of the CPAs that I talk to, when you ask them like, okay, what do you want from us? What do you hope happens? If you've closed on this deal and you look back on it years after you've closed, or even 6 months after you close, like what has to have happened for you to be happy with the deal? And I would say like 90% of the time, the primary answers I get are, well, money is definitely in the top three. People are definitely concerned about getting the maximum value. But then sometimes a higher priority is I care about my staff, or I really want my clients to be taken care of. And I would say that it's genuine. Most CPAs deeply care about those things. And when you have a big buyer pool, and you're on market and you have a bigger buyer pool and you have a very efficient process for evaluating buyers, you're able to then kind of sit back in the catbird seat and focus on fit. And then the numbers kind of take care of themselves.
I think that's a good way to look at it. And I think you also, often, right, we have ideas in our head where we think certain things are priorities to us. I think once you end up having multiple offers in a structured broker process, you'll get to see which one of those factors really is pulling at you, and it might surprise you. You have, that number of options to choose from. Again, you might gravitate more towards, hey, this group, the background of the principals involved, they have, prior CPA experience, right? They have a vision of, hey, I'm going to run this for, 10 plus years, right? Not necessarily just, flip it and sell it in 2 to 3. Or maybe, in fact, that's what you want is, hey, I want to exit now and I want another bite at the apple in 2 to 3 years. As you start to have those conversations with multiple interested buyers, I think it's then easier to imagine yourself in that situation going forward. And I think that's where you have kind of the aha of like, oh, now it becomes clear, like,
right,
may or may not be for the most absolute value, but this is the structure I want to operate for the rest of my career. Because increasingly, we're seeing these offers made to firm owners who are, in their 40s or early 50s.
Right.
Their head is not really thinking about retirement yet. Right. So again, you've got to address that situation where you're shifting from being an entrepreneur to being, a partner and employee. And that comes with a little bit of a different feel. And I think it's important to have, a number of those discussions so you really flesh out some of those concerns.
Yeah, I think a good example that most people are probably find easy to relate to because they do it often is when you hire. If you've ever run a really good hiring process and you've got a lot of candidates in your hiring pool, I know personally I've had an experience where I'll interview somebody and I think, oh, this would be a great candidate. This would be awesome, But then you got 2 or 3 more interviews lined up, or 4 or 5 more interviews lined up, and then the next person comes along. You're like, oh, I didn't think about them having this talent or this skill. Like I could see how that could really be applied. And once you've interviewed all the candidates, you realize like, wow, first of all, my job description might have been a little off. Like I didn't quite know what I wanted until I talked to all these people. And I'm glad I didn't hire the first person, because the third candidate, the fourth candidate was absolutely superior. So yeah, it's selling's a hard thing. And when you're doing it yourself, I know a lot of CPAs help their clients with a sale, but when it's your deal, it's an emotional thing, and that's normal.
Yeah, and I think that emotion is one of the main things of like how do you sort of prevent that from being the full defining factor, right? To be able to
Yeah.
keep the head, and I think that does end up being much easier when you have when you have other options.
Thank you for tuning in to another episode of the Accountant's Flight Plan. We've got a special offer for our listeners. If you want to save $250 on Accounting Practice Academy, our 8-week practice management workshop, use the promo code POD250 when you submit your application and start building a practice you would buy.
Yeah, and this private equity thing, I think just zoom out a bit, look at it from the industry's point of view. It's like it's a really interesting phenomenon, and we've seen it. I've talked to people who in the vet space who've gone through that consolidation, and it's an interesting thing how these PE firms work and how they how they do have very different visions for what they're doing. I wonder though is how much you can trust their time frame, because I've asked we talk to probably 10 PE buyers a day on our buyer team, and we can't find any that are honest about, we're going to be out in 2 or 3 years. No one says, normally the answer we get is, okay, what's your time horizon? They're like, oh, we're indefinitely in the industry. So I get a little, what's the word I'm looking for? Skeptical about what their actual intentions are, some of them. And so some of them we're curating a bit of a preferred list, but I do wonder about that component. Well, it's like, how accurate is that?
I think to some extent, they don't always know. And the reason I say that is that, within their fund, they might have a mandate. So it could be the time horizon of the fund is X number of years, right? And that's a target goal. It's not necessarily always hard and fast. But the reality is within that, what they're going to do is try to time the market. So one, on the operational side, they want to put the firms together. They want to make it into an efficient, larger firm. Most of the groups that we're talking to, at least most of the ones that I've been talking to recently, seems like the capital range of like 100 to 200 million seems to be kind of where some of the players are. So they want to deploy that, make the firms efficient, and then sell at the best valuation that they can, right? So part of the valuation is going to be determined on the success of the firm itself and the efficiencies, but the other part is where the market is, right? You've got to have somebody willing to buy at that price. And so I think we are seeing the valuations across the space go higher currently as that's happening. There's no guarantee that continues, right? It feels like right now that there's almost no ceiling on the valuations that people are willing to pay. That doesn't necessarily always last, right? So the way that it can kind of go bad is if they start overpaying for practices, and then suddenly you run out of the buyers and valuation goes down a little bit. They can offset that a little bit with the scale and the operational efficiencies, right, and being smart on the entrant. But, at the end, there has to be a buyer there on the other side. And so as things consolidate, those buyers will be larger and larger. And then, time will tell if they've timed the market, correctly. I think if you got in 2 or 3 years ago, you're probably feeling really, really good. I think if you're getting in now on the private equity side, you got to be smart, because you're no longer being able to, gobble up firms at 3 and 4 times EBITDA. Those numbers are higher now.
Yeah. Yeah. It's an interesting market for sure. And I do think there's a lot of opportunity for improvements in practices. We see that with our Accounting Practice Academy, we see a lot of CPAs, owners struggle with the same things. And, a group like private equity groups who have a lot of experience with some of these same issues, because the issues in running an accounting practice are often the same issues running any business. You've got to make pricing decisions, you've got to make hiring decisions and system decisions and all of those things. And I do think there is a lot of opportunity within practices.
And I think from an economic model perspective, that would certainly be what private equity says that they bring to the table. So, if you look back to other examples of roll-ups and such, the key thing there is that you take kind of a fragmented industry, right? And you start to institute basically kind of typical corporate practices, right? And so you start to act more as a larger firm rather than, an independent owner operated firm where, if you're just a single entity owner operator and you're making, good cash flow a year and you vacation and you've got a second home and you're living a good life, you're not necessarily entirely focused on the processes and squeezing out, the margin on the firm, right? So you shift from that type of environment to one where it is more corporate, it is more standardized, there are more group practices. And, within that context too, as the firm adds practices, like what they typically do is institute best practices between the firms. So they might integrate the new firm into the mother firm, but they might also take, oh, hey, this firm does it a different way. And that looks like that could add an advantage across the whole enterprise. So then they might institute your practice on certain things into the firm. And that's the way that they create value primarily.
Yeah, just spread those best practices around. And it does create, I can see how it would work. I can also see some potential pitfalls, but I'm sure some of those will happen too.
Yes. And I think the pitfalls are largely related to, vision, right? Making sure that they have, if you're a seller, making sure that the vision makes sense and aligns with what you're looking for. And then I think also prior experience in the space. If it's someone with just a pool of capital that doesn't have experience in the space, then there's just more risk there. Doesn't mean that they can still win, but there's just more risk if you're not familiar with the space.
Yeah. Yeah. Well, I always like to get our guests to kind of share a story. And you had one particularly about someone who was really good at doing these consolidations. Can you tell us about?
Yeah, sure. And this is not so much a personal story, just sort of being involved in capital markets. And I'd say one of the classic examples of someone who does roll-ups, is Wayne Huizinga from the 80s and 90s doing, first with waste management. So rolling up that industry, acquiring a lot of fragmented operators and making it into large enterprise. He did the same thing with Blockbuster. I'm certainly dating myself here as I go through some of these names. And then he did AutoNation as well, where he bought up dealerships and converted it into a single format and scaled that, right? And the commonalities there are, it's a fragmented industry. There's attractive valuations and there's decent cash flow. But it's in an environment where if you add capital to it and you add scale to it, there's significant efficiencies because of the fragmented nature. And so, I think that goes back to your initial question of, am I surprised by private equity's interest in this? Like, definitely not, because all of those boxes are checked, right? Where increasingly what we see across the board is if you're in virtually any industry these days, if you don't have scale, you're still, the dichotomy there between the strength and the weakness is very different today than it was previously. And a lot of that is driven by tech and everything else. But yeah, that's definitely part of the reason you see the private equity money coming in here.
Yeah, that was the other thing that I've been thinking is like, we just came from Engage. And one of the things that was one of my takeaways from the conference was like, everything is AI. Like all of the vendors that are in front of all these CPAs are all about AI. And I think I sort of wonder how true it is. Like, we could slap AI on our banner if we wanted to, because we do use some of it for marketing and that. But AI is a real thing. And I think these PE firms will be probably, a lot of them will be early adopters there. And
I would say both on AI and on outsourcing, right? Because what they're going to do is focus on the efficiencies and getting the profitability up. And those seem like the two obvious ones. And so again, if you can imagine, you acquire a bunch of firms that have, 40 to 50% cash flow. You start outsourcing some of the back end. And, if I've heard from some firms who say, effectively we have unlimited capacity through outsourcing. So it's just how many people we can bring in through the front door. The AI playbook would be very similar, right? And I'm less sort of knowledgeable in that area, but the process is the same, right? You're floating work at a much lower cost, right? So I think that those will continue to play out here in the same way they are across all sectors. But I'm not of the view that AI is going to eliminate all of the jobs. I think AI is a tool. And, the people that are able to interact with it and use it as a tool, as opposed to just use it as a, knowledge base, those are the people who are likely to win, whether you're an owner or whether you're an employee.
Yeah. Yeah. All right. One last question and we'll wrap up. Book. What's a good book recommended? Favorite book?
I'm about to go on vacation tomorrow, and I'm going to reread one of my favorite books, which is Keith Richards' autobiography. And I think it's from a pop culture perspective, I think it's amazing. I also think from just a perspective of life and what things were like, in earlier time periods without digital technology, it's kind of amazing to read about what, people with that much fame and access, how much they actually interacted with like normal people back then, as opposed to today, it's all ring fenced and, you've got this, stratospheres of different groups of society. Back then, they would drive around Mississippi and Arkansas and, get arrested by local cops and have, insane interactions with that sort of thing. So it's a really, from a historical perspective, I think it's really, really interesting book. And
yeah.
You got Keith is an incredible personality. The band itself. Yeah. So
and the fact that he's still alive is just incredible.
Yes, he's quite a specimen.
Yeah. So, well, Morry, thank you. This has been awesome. I'm going to answer the last question because if you want to reach out to Morry, the best way to find him is go to PoeGroupAdvisors.com, and he's our regional market leader in California. He's on our About page. You can find all of his contact information there. So, Morry, thanks.
Awesome. Thanks, Brandon.
Thanks for listening to the Accountant's Flight Plan podcast. You can keep the momentum going by subscribing and sharing your thoughts with us. Visit our website at PoeGroupAdvisors.com for more resources and tune in next time for more exciting conversations like this one.